Welcome to episode number 219 of AAA Weekly Knowledge Series. The regulations are also notified. So everything has been done other than the CIIRP, cross-border insolvency and group insolvency. So today we are not discussing this CIIRP, means creditors initiated insolvency resolution process, the group insolvency and cross-border insolvency, but we are discussing everything else. No, there is no point now discussing, because for the last 3 months this particular subject is going on. First we discussed what are the amendments notified in IBC Act. Then we discussed the regulations one by one. Then there was another regulation on 6th June, the fourth amendment to CIRP, that was also discussed. Now we have, our team, me, Ankit, have in fact framed some questions which are generally being asked in the professional circles, not only to us, to others also. The processes have seen a lot of changes, timeline changes, the obligations of the RP, obligations of the liquidator has changed. So based on those questions, based on the questions that our team actually has created, just to clarify the processes. Most of the time that we would spend today, what is applicable to the existing processes, may it be CIRP, may it be liquidation. So first series of the question comes on the kind of various timelines and various obligations of the resolution professional. And Ankit, let us start from this part, because in case we see this various timelines, whether it is applicable to the existing process, whether it is applicable to the existing liquidation process or CIRP process. So these are the questions which are actually disturbing a lot of the service providers. So what are the few questions that based on the timeline that we can start?
So let's start, and I believe we have a lot of questions, and we should give kind of this you can treat this as a rapid fire round.
Yes.
And the first question is that 180-day liquidation mandate, does it apply to ongoing liquidations?
No, very clearly this regulation 44 very clearly says that it is prospective only. It is not applicable to the existing liquidation cases, and this will not create any difficulty to all the liquidators. So this is very clear. So I would refer to the explanation which is in regulation 44. They say that this regulation applies to liquidation processes commencing on or after the date of commencement of the fourth amendment regulations, that is 1st June 2026. So any liquidation process which has commenced after 1st June or on 1st June 2016, this 180 days timeline liquidation mandate would be applicable, but not to the existing ones.
But I believe we anyways have a mandate to expedite and close all the liquidation processes that are going on ASAP. So irrespective of the 180-day timeline, I believe everyone who is holding on to any liquidation assignment prior to that, the instructions from IBB are very clear that close them ASAP. This is the idea.
Absolutely.
Moving to the second one, COC constitution in ongoing liquidation. So is it mandatory immediately, or can we continue with SCC for existing liquidation cases?
No, very, very important question. In fact, in our team also, since we are handling more than 100 liquidation cases, our entire team is presently occupied in reconstitution of committee of creditors. In most of the cases, we are supposed to reconstitute the committee of creditors, and immediately we should have a committee meeting, and those who are excluded from the COC membership, they should also be communicated, and those who are added to the COC membership, they should also be communicated. So that is what actually, so this is, there is nothing mentioned that it is prospective. So that means it is applicable to the existing liquidation processes.
Rather, the Amendment Act itself has an explanation where the explanation says that some provisions of the amendments will continue or rather be applicable to any liquidation process that has not, where the dissolution application has not been filed with the adjudicating authority. So it extends that the retrospective application to one, the COC review of the entire liquidation process. Secondly, it gives rights to replace the liquidator, and thirdly, it also allows the review and the powers of the COC are also extended to the entire processes.
No, I agree, Ankit. See, one thing which is the rationale, Because see, the regulation 31 capital A is totally omitted from the liquidation process regulations. And that was the regulation which was governing all the regulations regarding the stakeholders consultation committee. So if that is completely deleted on 1st June 2026, then what we are left with is committee of creditors. So therefore, there is no possibility of having any stakeholders consultation committee meeting. So it is only committee of creditors with reconstitution. Now, there is a question now, while we do the reconstitution, should we also re-verify the claims considering the explanation given to section 53? So we are doing it, and we will also give you the rationale why we are doing it. Now, earlier, a secured creditor was a secured creditor for the total amount of claim. But now, Section 53 has an explanation says that the secured creditor would be secured to the extent of the value of his security interest. And the value of security interest will be based on completely the registered valuer's valuation to the security interest, to the creditor's security interest. Now, we are also doing that, although it doesn't make any difference in the voting power. Because see, the rest of the amount will come as unsecured financial creditor, secured amount will remain as a secured financial creditor, and then unsecured financial creditor. Although Section 53 does not use any secured financial creditor word, but yes, secured, if it is a financial creditor, it would be considered as secured financial creditor and unsecured financial creditor. So therefore, what steps immediately are required? So the first step immediately required, the constitute COC at the earliest, and immediately have the meeting, communicate to those members who were members earlier, but they are not members now. That communication should go to that.
Next question for you is liquidation fee shall fix versus may fix. So does the change apply to existing liquidations? The change in the fee part.
It is not applicable to the existing liquidation cases. Whatever fee has actually been settled between the creditors and the liquidator, may it be as per regulation 4, it would continue. Now, see, when we see the draft regulations, in the draft regulation, it was mandated to the committee of creditors that the committee of creditors shall fix the fee of the liquidator. But now in this final regulation, when there is an explanation added in regulation 4, so it says this regulation applies to liquidation processes commencing on or after the date of commencement of 4th Amendment regulations, that is 1st June 2026. So therefore, it is not applicable to the existing fee structure of the liquidator. The committee of creditors may fix, but it is not possible that they fix of their own. If there is a voluntary renegotiation of fee between the liquidator and the committee of creditors, that can always happen. There is no change in that. The voluntary renegotiation can always happen. Otherwise, as per the mandate, the fee will continue.
So explanation to regulation 4 is limiting the applicability prospectively. Second, the change that we are talking about is that even for prospective or the future liquidation assignments, the COC may fix the liquidator fee. Next, we have the question is distribution timeline. So 15 days versus 90 days. Does the 15-day clock apply retroactively or retrospectively to realizations made before amendment? Because no, now one will have to distribute within 15 days.
This is covered in Regulation 42 of Liquidation Process Regulations. It was mandated earlier that within 90 days of the realization, it has to be distributed to the creditors. It is nowhere mentioned that in case there is any dispute for distribution, if there is any dispute on claim verification, then this amount would be kept aside and would not be distributed. But that 90 days has now been reduced to 15 days. And Regulation 42 is very clear that from the date of receipt of amount, the moment amount is received, the 15 days gets triggered. Now, in case the amount is received after 1st June 2026, then this 15 days is triggered. If the amount is received prior to that, it is always good to distribute as early as possible. Because see, no creditor would like that you keep this money for a longer period unless there is a reason. So therefore, what we are doing is, and that's what we would say everyone. So from the date of receipt, the creditors in fact comes to know that there is a receipt. So they chase 10 times in a day that when are you distributing, because every bank, every creditor has a target. But one issue, it is important. Now, what practice that we follow, for example, we received say 1 crore from sale of any liquidation asset, and we estimate that in the next couple of months there will be an expenditure on the liquidation which will be about 20 lakhs of rupees, including the liquidator fee, including various other expenses like security expenses, litigation expenses. So we actually had been doing that. We had been distributing 80 lakhs out of that 1 crore and 20 lakh that we were keeping as liquidation cost reserve. But the good practice would be that the entire amount should be shown on a table, less the estimated expenditure for the future liquidation cost, and that also should be approved from the committee of creditors. Otherwise, somebody can raise a question that you have not distributed the full amount within 15 days and you have kept some part as cost, liquidation cost reserve, but the liquidation cost reserve should be approved by the committee of creditors. That's what I'm saying. Secondly, in case there is any dispute, regarding the distribution, regarding the claim verification, it is recommended that that disputed amount should be kept aside. It should be kept in interest-bearing deposits, and it should also be minimized that this is the amount which is disputed. So disputed amount is separate. Liquidation cost reserve is separate. Rest everything should be distributed within 15 days. If the receipt of amount is after 1st June 2026.
Next question for you is Section 53 waterfall. So new regulation 21A and secured creditors. Does a secured creditor who files Form G on day 10 lose the relinquishment rights if they count only 14 days from the old LCD date that was before amendment?
So this particular problem will only arise in few cases, maybe only a couple of 1 or 2 cases. The assumption in this question is very, very kind of unique. But what we wanted to highlight that the relinquishment earlier 30 days were allowed. Now only 14 days are allowed. So the relinquishment, the creditor only has to relinquish within 14 days. It is not 30 days. So when the Form G is filed, and in case the Form G is filed a day before than 1st June, so that's not very important. So we should actually say that the relinquishment, when this Form G was submitted, as on that date, it was 30 days. So this 30 day would continue. In case the Form G is submitted after 1st June, then it is the 14 days.
I think in these circumstances, the benefit of doubt or the expanded timeline is offered to the applicant, in my opinion. So I think we can say that, yes, that is what should be applicable here. It should not be that we restrict this to 15 days where LCD was prior to the amendment. Nobody could have foreseen that, yes, after this amendment, their time period will shrink.
So most of the questions that we have actually crafted is trying to basically analyze what action is required in all existing cases. These are the kind of questions that we have taken up.
So next question is unrelated OC observers. So related party filter that was there. Can a promoter connected vendor still be invited as an OC observer in an assignment which was going on earlier? Because now there is a restriction that has been placed in Regulation 16.2A, and new Regulation 16E has also come in, which limits or does not allow related parties to come as observers.
So the problem before the regulator was that in all those cases where the operational creditors were making the committee of creditors, 18 largest operational creditors will make the COs. And out of 18 largest operational creditors, there may be many as associate companies or related parties who were supplying to the corporate debtor. Now, this is a clarification that it is only the unrelated.
So the word unrelated has been added.
So
it said 18 largest operational creditors.
This is also an action which is required to be taken by the resolution professional, because see, those unrelated parties who were earlier member of the committee of creditors having a voting share, it has to be communicated to them that from future committee of creditors, you would not be an observer in those committee of creditors. That communication must go, and in any meeting post this amendment should not have them as observer in the meeting.
So practically a declaration maybe with some documents will be enough from these observers to establish that they are not related, or maybe the own analysis of RP will be required with respect to who were the promoters, who were the shareholders, and is there any related party trigger with respect to the observers? So independent verification.
Section 5, subsection 24 is the definition of related party. So the RP will see whether out of all these observers, members of the committee of creditors, operational creditors, is there any related party or not? That would be seen based on the claim document submitted. In case any claim document is required only to verify the related party concept, that has to be asked by the RP. But another which is important is the new section which actually came as fourth amendment with effect from 9th June 2026. That actually says that in case like unrelated is okay, but there is another issue which is based on again the feedback that if any committee of creditor has.
So to clarify, we're talking about CRP now.
No, I'm sorry, yes.
So it's very important that because committee of creditors, of course, is both way, but here 16E, the part is applicable to only the CRP. It is really not applicable to the liquidation process. So of course, it can be applicable to future COCs.
Because the 16E is not applicable to liquidation processes. Similarly, 16 subsection 2 is also not applicable to liquidation processes.
Existing liquidation.
It is not applicable to existing liquidation cases, or even it is not applicable to the
future liquidation. The COC will continue as it is.
Yeah,
so maybe
future the liquidation, the COC will continue as it is. So this regulation 16E of CIRP regulations, which says that in case the committee of creditors consists of non-financial institution and scheduled banks. The word is non-financial institutions and non-scheduled bank, and their voting power is 66% plus. Then in that case, 5 largest operational creditors will also be taken as observers in the COC
where they hold more than 66% voting share.
Where they hold more than 66% voting
share. So one has to, the RP will now have to classify that, okay, these are scheduled banks and PFIs, how much shareholding or voting share do they have? Wherever their voting share is not more than 34%, there this will apply.
But maybe there are NBFCs. NBFCs are not scheduled banks. NBFCs are not financial institutions. That any COC with a lot of NBFCs or other creditors, they will actually have to call 5 operational creditors largest, and out of the 5, 3 must be the largest statutory authorities in case they have a claim.
So basically these observers, they will act as observers. They will not have a voting share as per 16E, but they will observe the meeting and make the voting shareholders more accountable to the outside world. So basically the idea was that wherever responsible institutions like banks and public financial institutions are not holding more than 66% of the voting share, it is required to have external members in the COC meeting to observe and make sure that the proceedings in the COC meetings are proper and they are not being the process is not being conducted to derail the process or to kind of create advantages to some parties.
So the only one question, Ankit, maybe you can also see, in case of existing liquidation cases, when we constitute COC now, would it be like 16A would be considered or not?
So we checked and we understood that 16E is not getting applicable there because 16E is not within the regulatory or regulations that are becoming applicable for the new regime. So anyways, I think maybe we can expect a clarification from IBBI, but so far we understand that this is not applicable on existing liquidation.
And why we are saying so? Because see, in the liquidation regulations, it is mentioned that the regulation from 18 to 25 or 24, that would be
applicable, and those are regulations
mutatis mutandi in liquidation cases.
And those are regulations which govern the COC meeting, but 16E, of course, is outside that.
16E is outside that. So this clarification is not there, and I think we can even write to IBBI, but then whether the existing liquidation cases will also have this structure or not.
Next question for you is corporate applicant in section 10, the new information requirements. Do the new disclosure fields apply to pending applications which are already before the adjudicating authority?
No, the law says that this is the information which is required to be submitted to the adjudicating authority in the case of section 10. So all this information is basically to give some more comfort to the creditors so that the creditors understand the value of the company. They also have the complete IM so that the value maximization is done. That is the basis of this additional information which the applicant under section 10 will provide to the adjudicating authority, and that actually will be passed on to the RP also and to the creditors also.
So I believe if a section 10 application is pending and the corporate debtor which has filed this application is serious with respect to getting the section 10 application admitted, maybe it will be a wise idea to file an additional affidavit, submit these additional documents that are now mandated under these regulations, and make this application foolproof for the adjudicating authority to decide on it earlier. Because one of the reasons why section 10 applications are delayed or not taken decision on by the adjudicating authority is due to lack of faith and lack of the belief that this is a genuine application sometimes. So I believe it can help.
Yeah, I think in most of section 10 applications, they say the other side is the creditors. The creditors normally
Object to the moratorium,
object to the intent of this application. So they can actually come that this application doesn't have even the 3 additional mandatory document on. See, therefore, the best practice would be that the additional affidavit should be submitted along with this additional information. That would be considered as a good compliance. But I would say, similarly, in section 9 also, there are various additional documents which are required to be submitted by the applicant. So in all those applications which has been recently submitted and still not accepted, I believe the court will start asking them that you provide this information also. And I think it should be provided, but not that the court will actually reject this based on this, because this is not retrospective. This is a procedural amendment, and the procedural amendment is prospective.
So next question is creditor's first meeting obligation under new regulation 4.3, the proviso. Does a financial creditor have to bring asset valuations to the first COC meeting if CRP started before June 2nd, 2026? Because what has happened here is that one has to furnish all the information with respect to relating to assets and liabilities, and that's where the financial creditors have to bring in all this information. So what happens there where the financial creditor is not able to bring this information in the first meeting? I don't think it will be very compulsory or very rigidly implemented.
No, see, we all service providers, may be IRP, RP, or the liquidator, we survive with the consent of the committee of creditors. We need to communicate to committee of creditors that this is the law now, and you, whenever you come in the next meeting, you please bring this information. In the recently initiated CIRPs, I would say that the creditors also need to get some notification that this is required to be brought. Now, the regulation 4, which has been changed, now it says every creditor shall furnish at this first meeting. So what the creditor is supposed to furnish? Number 1, it is the valuation reports, whatever valuation report they've had in the past, stock and receivable statements submitted by the corporate debtor, inspection reports, inspections conducted by the bank officers, or maybe also some forensic audits, and then the title search reports of various properties owned by the corporate debtor. That is what is the requirement that every committee member should bring in the first meeting. In case the first meeting has already happened, you should request him to bring this information in the subsequent meeting. That is what is the best practice. Yes. And even otherwise, even if in those cases where the CIRP is initiated after 1st June 2026, in case the creditor is not bringing that information in the very first meeting, the service provider will only request him. But in case, this is very important, in case the creditor is not providing this information and you think that information is available with him and he's intentionally not providing, then it is a case under section 19, subsection 2. Because he actually is a party. He is having a responsibility to provide information to the RP or the service provider or the IRP, and if he is not providing, the RP must file section 19 subsection 2 application to adjudicating authority.
So that's where I believe an important change has come in. So I think this will require the resolution professionals to follow up rigorously with all creditors and make sure that this information comes on the table. There is also a new form now which has been implemented as part of the circulars, and this was not in public domain earlier, which documents or kind of has complete details of the custody and control taken over by the RP.
Yes.
From the management and what all documents have been received, what all documents have been received completely, partially, or have not been received with remarks. And also then the table also it also lists down that what all assets have been taken custody of, also lists down what information or documents has not been received, and then again the remarks of the RP on that. So this kind of a format that has been prepared now then requires signatures also of the corporate debtor.
Yeah.
If the RP has shared this format and said that these are the list of 15 items that the corporate debtor has not provided, even if the corporate debtor representative does not sign it and does not send it, it can still make a fit case for 19(2). So those repercussions also come from there.
Now, this is a good format which has actually been developed. It is notified as a circular. It is a form, and this form, it's a must to use. So we have actually we have asked to all our partners that this form should be filled up in all those cases where the custody has actually started maybe in the last 6 months. Even we've been doing it, but then we've been doing it as Panchanama form, and we picked up from SARFAESI actions. So now from that Panchanama form, we shift to this form. And this form also has an information what was asked to them, what was provided, what is balance. And this is with the signatures of the parties.
Next question for you is claim verification related, where we need to understand that what is the reason requirement in the amended section 13, regulation 13(1)(a). Must the IRP give reasons for every claim rejection? If the claim was rejected in, let's say, April 2026, is he now supposed to give the reasons now?
No, in case the RP rejects a claim, there is a possibility that an application is submitted to NCLT. And the NCLT will first ask, what are the reasons of rejection? Now, in case the RP says that I have not given the reasons, then the other party will say, despite the amendment you allowed, he is not given the reasons. So therefore, it is advisable. In case any claim is getting rejected, detailed reasons should be given. Before this amendment and after this amendment, it is not important whether this claim was verified before the commencement of this amendment act or after the commencement. This should be made as a practice that any rejection should be with the reason. That's what is very clearly said, that regulation 13, 1 capital A, it says along with the reasons for the same. But in case we provide reasons, in fact, it neutralizes the possibilities of ambiguity and also a kind of some kind of adverse comments from the adjudicating authority on the conduct of the RP. Reasons must be given.
So next one, guarantor assets transfer, which is now proposed in regulation 28A and 28B, subsequent to insertion of a special section to this effect in the Amendment Act itself. So valuation by registered valuer, it says, is mandatory for this case. So can we use the creditor's own valuation for an ongoing 28A transfer, or will it require a fresh valuation?
No, Ankit, this regulation 28 capital A is very clear that it has to be a valuation from a registered valuer. And even if the registered valuer has valued earlier also, but this should be a fresh valuation.
So the valuation date will be close to the date on which this transfer is happening to the CD.
Yes.
This is where the fresh valuation is required. And of course, since IBPI is IBPI has of course come out with new guidelines for valuation professionals or registered valuers registered with it. Our IBPI would want registered valuers to do this kind of a valuation to have a foolproof kind of a mechanism here.
But firstly, for this valuation, the cost will not become part of the IRP cost. This particular cost will be borne by the creditor.
Because the creditor is going to get the benefit out of the sale.
Because out of the sale, the creditor will get the benefit. And also, like in case the grantor is giving an asset for a collective resolution, so he is giving the value as per the valuation report, and then there should be a resolution in the committee of creditors that in case the resolution plan is more than this value, then how proportionately that additional amount will also go to the creditor who actually has merged his asset into the resolution process. That also. But then, first of all, his claim is already there. Because any asset he can hold as a collateral security which is not owned by the corporate debtor, but his claim is already there. By just combining the asset, his voting share is not changing. But the definition of secured creditor as per the new explanation added to section 53, that is something which is a question. One, that he may have still pari passu charge, or he may have some other assets owned by the corporate debtor and he would be secured to that extent. Plus, he actually has another collateral security and he would be secured to this asset as well. However, his voting share will not change because he has a claim on the corporate debtor.
So next question, we have a new idea which has been implemented in the CRP regulations, amendment regulations, which is going concern assessment report. Now this going concern assessment report has been introduced via regulation 31B sub-regulation 2. And is it now mandatory that, because this says that in the first COC meeting you have to assess or you have to present a going concern, the RP has to present a going concern assessment report based on which then the COC will take all the decisions. So do we implement this retrospectively and prepare this for earlier COCs that have been held, where whatever decision COC has taken has been continued?
No, Ankit, it's like funny. I got a call that, in fact, I had my first COC meeting on 5th of June. This law was effective from 9th June 2026, and I did not present a going concern assessment report document in that meeting. And should I do it again, or should I do, because that was my first meeting, so I didn't do that. So now am I required to do this in the subsequent meeting, or I'm absolved from this responsibility? So what I guided him that this is again a procedural amendment. If it is a procedural amendment, the objective is to take an approval from the committee of creditors. What approval we need? We need approval on 4 fronts. And the one front is basically the income. What would be the income in this period when the company is being kept as a going concern? What would be the expenditure? What would be the cash flow, to understand how much is the cash deficit? And then what kind of working capital is available and what kind of working capital is required for this? And then for keeping the company as a going concern, whether there will be any value erosion or value enhancement. So this is the going concern assessment report. Now, this going concern assessment report is, in any case, it is required, because otherwise the committee of creditors will not approve your expenditures. So this report, now it is mandatory to present it in the first meeting. So in case in the first meeting the information is not available, it can be done in the second meeting. So in case the first meeting it was not applicable, it should be done in the second meeting or third meeting, whenever the information is available, acceptable to the committee of creditors. It is also possible that the COC can understand your report, but the COC can ask questions and the COC may not approve it in the first meeting. So this is something which is completely a practical question. But yes, I would say it is procedural. It is not retrospectively, it is prospective. But this process can be done anytime, even in the third meeting also or fourth meeting also.
So next question is, so there is a new regulation 31B sub-regulation 4, which says that prior approval of all post first COC meeting costs is required. So can the RP now incur emergency costs without COC approval? How does because in the case of going concern operations, how do you envisage that this regulation will be implemented?
No, see, there is no mention of any emergency expenditure. There may be, even in our case only, yesterday my security guy was saying that because of all these kind of winds and trees falling, the wall of one of the secured asset that we have in our custody is actually broken. No, I can actually immediately send somebody to repair it. I said no. The guards are there, they will protect the goods. But immediately we will prepare an estimate, take an estimate from 2-3 people and then present it before the COC meeting. Prior approval is required for any such emergency cost. Practically, some of the people, they ask questions to me. Practically, if the COC is not constituted, then what do we do? I said, if the COC is not constituted, we know the applicant, we know some of the other creditors, and we should send them emails along with the evidences. And we should tell them that this is what has happened and we have to take such actions. The COC will understand the reasonableness. And if the COC doesn't understand the reasonableness and they in fact try to even reject those expenditures, then adjudicating authority will understand. If it is reasonable, if it is urgent, if it was mandatory. That is what is the requirement. However, what exactly is saying, one, that there is no provision regarding any urgent emergency expenditure, the IBC may take a call that if there is any situation of such expenditure, how to deal with this.
So I believe this has to be read with sub-regulation 5. Now, sub-regulation 5 talks about a variation statement. It says, what if actual costs are exceeding estimated costs? So for going concern operations on a month-on-month operations kind of a system, one can have budgets for various expenses, in my opinion, and wherever the actual cost is having a sharp variation from the budgets, that can then be presented in this variation statement as stipulated, because one shouldn't read sub-regulation 4 in isolation of 5, because the idea is that, okay, you will tell the COC that, okay, this is the going concern operations, these are the costs, this is the revenue that I'm expecting in the next month, and that the actual is this for the last month, and then the budget for the next month. This is how even operations in a going concern are kind of reviewed by promoters. So I believe a similar aspect is thought of, that you have a proposal, then you have a budget, you have an actual, and then you talk about variation, then you again present the next month's budget.
This is rather a more difficult task for the resolution professionals. See, first of all, there has to be a approval of future expenditure. Then in the next meeting, there would be a comparison between the actual expenditure and the estimated expenditure. Then there will be variance report, and the RP would be required to give a variance report and the reasons for the variances. The COC will understand if some expenditures were not even apprehended, so those expenditures fall in, so that was incurred. But this actually will become a complete documentation of the CIRP cost, liquidation cost. So the transparency will actually go 100% in such case. So because the COC members, they understand cost, they understand the various prices in the market, and nowadays the prices are also available.
Very, very good control mechanism, that if there is a representation to the COC that going concern operations are profitable, they will be generating a surplus, and the actual cost invariably exceeds the revenue, and it is rather increasing the CRP cost, then that is something that will get controlled due to this process. Next, with respect to the COC plan deliberation, so there is a mandatory recording of 3 heads in COC minutes now, which is amended as part of Regulation 39, Sub-Regulation 3. So the first plan approval COC meeting happened before 4th amendment. Do we still need to redo the minutes and talk about these 3 heads that now are required to be recorded? That what is the technical feasibility of the plan? What is the adequacy of market discovery and the expected realizable value versus the fair or liquidation value? Let's say a resolution plan has been discussed, maybe not approved, but still this discussion is not monetized.
So this regulation 39 is again a procedural regulation. It only provides for a procedure, that this is what the COC will have to do. So therefore, all procedural would be applicable prospectively. It is not retrospective amendment. But the question is, like when a resolution plan is submitted, and if somebody has to file an objection, he can also say that even the compliances of this section, regulation 39, was not done. Now, what are the compliances and how difficult it is? It is only kind of just preparing some minutes. The 3 things have to be recorded by the committee of creditors, 3 deliberations, and one is the feasibility and viability of each resolution plan. Like if the resolution plans are 10, for all the 10 resolution plans, this has to be deliberated and recorded. Then is the expected realizable value versus fair and liquidation value. Now, the fair and liquidation value is, I think it is referred to the valuation report, because the valuation report will give fair and liquidation value both. However, the expected realizable value, now that part is slightly difficult. How the committee of creditors will understand what is the actual realizable value when the fair value and the liquidation value, both reports are available. So what kind of reasons are expected from the committee of creditors? What kind of deliberations are expected? That is not understandable. 3 thing is very easy again, adequacy of the market discovery. If only one Form G is issued, only one resolution applicant has come, if the publicity has not been done, if there is no evidence that the RP has tried to reach out to many, so then it is difficult to see whether there is a adequacy of of market discovery or not. Market discovery has to be deliberated and it has to be recorded.
So the expected realizable value versus fair liquidation value, I believe, is the realizable value is meant to be the value which is available through the resolution plan. So therefore that is available.
Yes.
So the NPV or whatever that plan is offering, that is what I think the creditors are required
So
to
in
manage.
each resolution plan, this is the value.
Yes.
This is the value.
This is the value, and this is the fair value and the liquidation value and how it is compared. So in case the COC is monetizing that the realizable value was way lesser than the fair value or the liquidation value, then it becomes a very reasonable ground for them to reject the resolution plan. So I think the litigation will reduce. Next question is very important, that many amendments are now have come in, whether it is through the Act or Amendment Act or through the regulations. So how does one apply them to existing processes? What should be the thought process there behind the professional or the liquidator who is working on these cases? Should he kind of keep a very clear mindset that no, these amendments have happened after my commencement and therefore I will not put them into application? Or I believe that, in my opinion, it should be a little more flexible, that some amendments, as you said, that some amendments are procedural, and those procedural amendments are important, or rather can help the process get over quickly. So I believe that is what the idea should be, that wherever it can be implemented, practically possible, and it can help the adjudicating authority or any COC member take a quicker decision or have a more fair decision making process, I believe it should be retrospectively implemented wherever it can be.
No, I think, Ankit, in this question we can discuss about some general rules. So in some amendments, it is very clearly written that it is prospective clause. So when it is written clearly, that means it is expected that it will be applicable for all the future action. In many regulations, there is no clause regarding retrospective or prospective. So then it has to be seen whether it is procedural or it's a clarificatory. If it is procedural, technically it is applicable prospectively, because the procedures we cannot go back. But procedural means, like, even if the similar procedure that you are doing today, this will be applicable, but you can't go back and change all the processes that you've done in the past. However, in the case of some major changes which are actually done by way of adding explanation or clarification or even illustrations, that is where it is applicable retrospectively, and it will be applicable to all those cases which are not yet concluded. Now, similarly, what I am trying to say is that in case we see section 53 distribution process in the liquidation cases, now the distribution process very clearly says that the security interest, what is the definition of security interest, that has also been added as an explanation. That means the intent of the legislature was the same. However, in the same section, there is an explanation which is added now. Similarly, the definition of secured creditor, again, it has come as explanation. So in case the distribution is pending, then it has to be recalculated, and all the differences in the distribution already made, that also has to be corrected by the liquidator. That has to be corrected by the liquidator by taking the money from those creditors where the distribution has actually been done excessive and giving it to them who are entitled to. So this is also required. These basic rules will actually help us in understanding what is applicable retrospectively, what is applicable prospectively, what is applicable to the existing, and in case the matter is already dissolved, company is already dissolution application pending, nobody will ask them to go back and take the money from the creditors and reallocate it.
So maybe I can skip that next question and come to the next one, where I say that this multi-amendment scenario, that a liquidation that kind of continues the pre-amendment CRP. So the CD was in CRP on January 2026 to May 2026, let's say, pre all the amendments, and liquidation order came on 1st June 26. Which rules govern? Old CRP rules or old liquidation rules or new amendment rules? What will govern? So because the liquidation order is dated 1st June. So I think we are clear that in liquidation, the retrospectivity with respect to how the COC needs to be constituted again and how it will continue has to be enforced, and it will be applicable on all existing cases. So I think that is what we need to kind of ensure there. With respect to real estate CRPs,
one issue is very clear in this. See, for this question, I would say like the COC, whatever has been constituted from the CIRP, that will continue. So there is no change which is expected to be made by the liquidator because the COC is already constituted. Now the claims has already been verified by the RP, and those verification would be considered as verification done, and it is final verification. So the liquidator is not supposed to again verify these claims. So this is what is actually required in these cases, and the CIRP cost is already freezed. Whatever it has already been freezed, it is not possible to go back and dig whether appropriate approvals were taken or not. Similarly, 180 days, the mandatory timeline in the liquidation cases, that is prospective, and it would be applicable only in those cases where the liquidation commencement date is 1st June or after that.
So real estate CRPs with home buyers under the new regulation 16E, I believe that the idea is that yes, this amendment which is being made with respect to related unrelated, we have already discussed how it should be retrospectively done.
In all these cases, I believe the committee of creditors are supposed to be reconstituted. Suppose in most of the real estate cases where the financial institutions and the scheduled banks are not having 66% share, in most of the real estate cases, the home buyers will have major share in the committee of creditors. So in all those cases, we actually have to take 5 largest operational creditors, and out of those 3 would be statutory authorities, including Noida Authority, including Greater Noida Authority, including DTCP. So they would actually be participating into the minutes, but they would not have any voting power.
Then dissent and challenge strategies. So creditor who wants to challenge a pre-amendment COC decision post-amendment, especially with respect to this dissenting financial creditor part, where the financial creditor, so how do we govern that? I believe that there is a cutoff which is stipulated in the amendment itself, and or how will this work?
No, this is a conflict which is expected. In a resolution plan, it is supposed to be mentioned that in what would be given to the dissenting creditors. Since the resolution plan is supposed to be submitted by the RA, and the RA is not having the copy of the resolution plan, copy of the valuation report. In such cases, he will only say in the resolution plan that he will allocate the amount to dissenting creditors as per law. No, as per law means when the resolution plan is getting approved, that law would be applicable. There will be a deficiency report which will be which can be the adjudicating authority can ask for it, that you provide us now as per the law. The dissenting creditor as per the amended law would be getting this much, and I haven't approved the resolution plan as of now. So therefore, this needs to be amended. Though practical reality is that the dissenting creditor will get the amount as per the latest law, because this clarification in the code, which is very clear, that if the resolution plan amount is 50 rupees and the liquidation value is 80, the lower of the two would be the entitlement of the dissenting creditor. This particular change is only to dissuade the creditors from dissenting, and the resolutions are encouraged rather than liquidation.
So, and as with respect to again, the stakeholders consultation committee still exists for ongoing liquidation started before amendments? Of course, no, it will not be.
It will not be.
A liquidator's fee agreed in pre-amendment agreements can be changed by the new regulation for rules. So,
no, it is not. It has to be.
It will remain. It will be
voluntary.
It can't be changed. It does not. It is not required to be changed.
Yes,
that is what the idea would be. If a secured creditor does not file Form G within 14 days of the LCD, they are automatically excluded from the COC. So, is this true or false? That if they do not file Form G within 14 days of the LCD, so they are excluded from the COC. So, I believe that if they don't file the Form G, they will continue to be the creditors, they will continue to. It will be deemed relinquishment of security. So they will continue to be part of the COC if they don't file an updated claim.
No, whenever they file claim, they will become the member only then. See, for becoming a member of the committee of creditors, the claim filing is must.
But for the LCD, because they are already part of the COC.
See, they're already part of the COC.
If they're already part of the COC, they will continue. So in case a creditor does not file their claim after liquidation is commenced, and their claim was already part of the COC, they were part of the COC, they will continue to be part of the COC.
Yes.
Rather, they are not submitting an updated claim will only be treated as deemed relinquishment of security.
Yes.
Then the going concern assessment report must be prepared for all ongoing CRPs from June 9, 2026, even if the first COC meeting has been. I think we should say that no. We should say no. We should say rather it should just be discussed that yes, this is a new requirement. This is what the COC has been doing in the past, and this is the decision that they have taken in the past, and these were the grounds, and this is how going concern will be continued, or going concern was never established in the first place.
Yes. Yeah.
Then a section 10 corporate debtor application, we have said that in case a supplementary affidavit can be filed, then of course section 10(9) or whatever applications are pending between the adjudicating authority, there is a possibility for how to kind of close that process, or rather take that process forward. I will quickly talk about the modifications in the final regulations as compared to the draft ones, and what were the modifications. So we have slight change. I'm talking about CRP regulations first. So we have a slight change in regulation 2E, where certain parts have been added. So 3 new clauses, that is tax demands, PF or ESIC dues, and PMLA or Benami FEMA related processes have been added. I'm talking regulation 2E is with respect to what all needs to be added to a section 10 application when somebody is filing for a section 10 application. Then we can talk about how the first meeting, the mandatory provision has been added under regulation 4.3 with respect to the information that the creditors have to file. Earlier also we had a clause that the creditors will give this information, but it was not shall, it was the RP has to get it from them. Then of course claim communication with mandatory reasons has been a change. Then we have guarantor assets, where valuation process has been tightened. Earlier that was not standardized. Now we are saying that it has to be done by registered, it is mandatory now. So wherever applicable has been dropped, now any time an asset comes through this regulation 28A, 28B process, it has to be valued. Then in 30A, a good amendment that I remember discussing with, or rather everyone discussing and sharing a feedback with IBBI, that only bank guarantee was part of the 12-way settlement part. Now what they've done is they've also added a demand draft part. So that was something that everyone gave this feedback to IBBI, and they have accepted that feedback. So demand draft is also added here. Then going concern mandate was not proposed. So one plan has to have a going concern mandate. That's a good development that takes care of many anomalies in a resolution plan, where multiple resolution plans are taking care of different business segments of a company or different assets of a company or of a CD.
But see, there's one clarification that was given in a meeting with IBBI. Like, see, whenever we say that in the very first meeting, the COC has to decide, after taking the going concern assessment report, whether they would like to continue with the going concern or not. So that means, like, they would not, in some cases they would not agree for this cost, and then the RP is not possible for the RP to keep the company as a going concern because of the deficit in fund flow. But what is the requirement? Because see, this will still be considered as the resolution plan. There must be one resolution plan which actually says that they will keep this company as a going concern. So there is no conflict, because see, when the COC says that we would not like to keep this company as a going concern, we will not incur this cost, that means it is temporarily suspended. But then the going concern status can still be maintained, because everything can be revived. If the workers are removed, if the material is not being procured, if the electricity connection is closed, everything can be renewed. So the going concern status is not adversely impacted, but it is temporarily suspended.
Right. So then we have the regulation 40E that is now completely redrafted. So this allows dissolution of a corporate debtor wherever there is no asset, nothing that can be done. So the complete process has been provided now. So wherever a company or a corporate debtor is there in CARP, I believe there is a very, very clear mechanism for the RP to take it directly to dissolution by following this procedure. We then have regulation 38(2)B, which talks about the guarantee release prohibition. So there was a prohibition that the guarantee cannot be released. This has been abandoned because it was felt that the Amendment Act itself takes care of this, so there is no duplicity required. However, there is still a bar now that personal guarantees cannot be part of the resolution plan. The resolution plan can only deal with the assets belonging to the corporate debtor. The resolution plan cannot deal with the personal guarantees of any of the promoters. So they have to be dealt with separately. Then we have, of course, all the forms that have shifted to the circular that is there. We have the Fourth Amendment regulations that came in on 8th June. Most of these were not part of any prior consultation. One was, of course, the OC observer eligibility. That unrelated part has been changed. We have talked about it. We have talked about the CRP cost governance, and we have also talked about the COC plan deliberation record. So these have been part of this CRP regulations that have been changed. And of course, quickly, I think I can also similarly talk about the liquidation part, that what has been the change as compared to the earlier part. So we have the substitution with respect to the 2A with respect to contribution to liquidation cost has been substantially changed there. So there the proposed deletion with respect to so power is now vested with COC and not a mandatory escrow. Basically, earlier it was proposed as a mandatory escrow. Then, of course, we have further change with respect to proviso has been added in compromise or arrangement. So there is a new regulation 3A which talks about COC recommends liquidator by 66% vote. So this is a good change that has happened in the beyond the DP, that now as per regulation 3A, the COC can recommend a liquidator. So earlier the interpretation was that the liquidator will mandatorily be selected out of the IBBI empaneled empaneled insolvency professionals with NCLT. But this regulation 3A now allows COC to recommend a liquidator who is not the RP.
Yeah, that's a very, in fact, that's based on the feedback. Yeah,
that's based on the feedback.
Reason of draft the discussion paper, and this actually is a good feedback that everyone has given.
Because everyone said that if you're allowing COC to choose their liquidator while liquidation is happening, why don't you allow them to choose the liquidator prior to liquidation getting started? It will only save time. I believe that has kind of been heard. Then, of course, the bar for the RP to be a liquidator continues because that is in the Act itself. Yes, so the COC will have to choose a liquidator who is not the RP. Submission of updated claims has now been modified to an extent, although it was basically because it has been changed now. And apart from this, I believe mostly there have been minor changes in the liquidation regulations, but mostly we have everything which is kind of being captured there in full capacity. With respect to forms, I believe that many changes in the forms that have improved the forms, and I think it's all in line with making the forms better. I believe there again we can touch base on important changes separately.
No, I think this episode 219, it actually is kind of through this question answer session, it actually gives us the complete brief about whatever has actually been changed, including the Amendment Act and various regulations. So the most important, it will be considered as a capsule for whatever has happened in the last 1 year. So this is a capsule for all this, and practically what is required to be done by the service providers, that also is completely covered by us. So thank you very much, and please subscribe to our channel in case you want this content. I would repeat that we only need more and more people should reach out to us for seeking knowledge, and there is no monetization that we have done for this YouTube channel. It is only our way of learning.
We feel encouraged by our subscribers. That's about it.
Thank you.
Thank you.